SMF, good morning. It's 6:03 a.m. It's a Friday. It's 8/19/2011. Options monthly expiration. And clearly, SMF has demonstrated making markets, and those markets are high volatility. There's a lot of manipulation in price prints, but my point of it is those very same calls. Here's a 5:30 call it's down to 10 cents by 25 pennies. That's what happens to people. Yesterday's high was 330. It doesn't matter. But they were tradable, and we made profits with them. Look what happened here to the 525 call. 550 down to 30 pennies. 40 pennies is the last print. What we're going to take a look at today is that Google is gapping down to 497.53 over the mobile Motorola. Hey, look, they wanted to own the patents. Patents cost money. And there'll be a day and time where they monetize it, make money from their investment. That's how they work. So that means that these calls are going to zero. Those are going to zero. And this is what happens in an options expiration. Look at the 495 call. We have it over here. The closing print was $12.80 right here. Let's go ahead and set bids at this one at 770 by 810. And let's also get an alert below 880 or lower. We'll be monitoring this one. They're going to gap it down. Here's the Google gap down right now. They're going to gap it down to the strike price. That means that this premium is going to disappear. And it's going to disappear at some point at a wholesale market. This equity yesterday had a very long left short side. Put side has just been ripping and paying, as you know, because you trade both sides. And we will see where that key support level is going to be and where that trade totally changes to the upside with the bid and ask ratio and the IRs and everything else ascending, and then the pullbacks intraday are diminishing pullbacks, not just slide the bid and then they become an immediate short. So what we're going to do is we're going to go over here and we're going to put a 490 in here, okay, and we're going to get rid of some of these that are going to go worthless, but we'll keep him here so that people have a record of it. Is what side of the market has paid? Well, it's the put side, and then you trade the call side on bounces against your original put side. So that's working fine. That 540 put, that 530 put, okay. The 520 put is working, okay. The calls over here, though, that 510 put's even working. What's up? Yesterday, look at the net change in it. Right here. That's your percent changes. Okay. 900% here, 1000% there. On the put side of the market here, 490. Now, what we're looking for in price action is when that reversal comes in, is when that pricing changes. And then you start getting print in the C column. So we have a 490 call. And let's put that 490 call right here and that level 2. Alright, at the strike price, what we are going to be looking at is a 500 put that's currently in the money right here. 498 closes at 504.88, gapping down to 4.9 or 498 ratio. Left elbow says they take the premium out of the 490 call. Let's set alerts. That's this one right here. Let's set alerts on this 490 call. Falls to 1150, 1080, 1020, 970, and 940. That's the lower end of that market tier level. Yesterday, the high was $29 a contract. Look at how much premium going to the home plate of today's expiration they already took out of it. Now they're going to take more. And at some point, the equity has to bounce. It can't just roll up like it did yesterday, 369s, and then immediately was weak in price. Could not consolidate half bars that would continue to break below those half bars. Yesterday's trading. What you're looking for is the opposite today. As far as the broader pre-market, the futures are gapping down big. S&Ps are down 17. Dow futures are back down 162. NASDAQ futures are down 26. They came off their lows early in the morning. And now the progression of that same type of tape that was happening yesterday is happening again in the futures market, pre-market. Okay, we're going to open up in 20 minutes. This is the Google trade. The reason why we're going to monitor that $500 put is because it's slightly right now in pre-market in the money. What we'd be looking for, if that peaks and then has a big reversal, that means that that call side is going to be bouncing up in price. 495 call and a 490 call with monitoring a $500 put, because we're down there at the lower end of where a market is going to get made at some point. MMTs, and there'll be a sharp reversal. Special opening bell, options expiration monthly, Google.